Good day, fellow investors. Today we are going to discuss how the economy matters or doesn't matter for investing going forward. It matters. But I know that the first quote that comes to your mind is Peter Lynch, and how he says that if you spend 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes. However, the key here is the forecasts. We're not going to discuss forecasts, we're going to discuss fundamentals. And the fundamentals now, and you also see Seth Klarman discuss it in the foreword of the new edition of Security Analysis, are that we have the Fed distorting market powers, distorting also economic powers, so we have to know what's going on and adjust our risk and reward exposure to those strengths. And therefore, it is extremely important to discuss this. And this actually came to my mind a few weeks ago when I escaped with my wife to Paris for a weekend. And I was actually shocked. We were in Paris and I was looking around and I said, what's going on here? It is not as great as one would think about. Homeless people, filthiness. You see that the sparkle there is gone. And then I went to check things as we were on the very fast train, and then I saw the following. If we look at France's GDP measured in US dollars, that is the global reserve currency, this was in 2008, and now 15 years later it is approximately there, maybe a little bit higher, as these are 2021 numbers. But this is 15 years of economic stagnation and likely a recession again around the corner for Europe. And even worse situation in Italy, actually declining GDP, and Spain similarly. And therefore, I was thinking, okay, this should also have a huge impact on our investment returns, which is why we are here, no? So I looked at the French stock market index. This is nothing. 6,000 now, 8,000. And you can see that the returns haven't been stellar. Compare that to Germany, that has seen 20% economic growth measured in US dollars, and I think this is a total return index, but still, from 8,000, 18,000 sounds much better. Not even to mention United States from 14 trillion to 23 trillion, and of course the S&P 500 is more than a 3x over peak to peak. And therefore, when it comes to investing, it's important to know the economics so that we invest with tailwinds. Because when you invest with tailwinds, if you make mistakes, those don't hurt as much. So let's discuss the economic outlook, and I'll immediately tell you it is unfortunately unsustainable. And this good stock market performance in Europe and the S&P 500 is not a fundamental thing. From recession fears, we are 40% up on lower interest rates expectations, with the S&P 500 76% up over the last 4 or 5 years. But everyone is betting on a Fed ECB put that will not allow markets to go down, will not allow recessions. And before discussing the risk and reward of investing and positioning, I have found a very interesting article as I was reading on these matters, lessons from Italy's economic decline. And you can see here on the chart how Italy enjoyed good times, relatively good times, 70s, 80s, but then here from the 2000s, you can see it flattening and actually declining out. Why? Well, you have those productivity cycles, but at some point, if you get too much into debt, then the contribution of capital to productivity gets lower, And consequently, you have a negative productivity factor because of too much debt, too much interest, too much cost, and then problems pile up with bureaucracy, political issues, etc., etc. And now, when I saw this, okay, this is the explanation, then I go and look at the outlook. And the best way is to go to Ray Dalio's, even if I don't like personally Ray Dalio, he has great data. And if you type into Google Country Power Index 2023, you will get to these great readings across major powers. He's looking from an empire perspective. But China and US are still leading. China is growing, US is stagnating, Japan declining, Eurozone declining, stagnating a little bit, but Italy going towards the negatives. However, the keys there are that the big cycle for the US looks mostly unfavorable over the next 10-20 years. Everyone is investing based on the past 20 years, but the next 20 years is what matters. And if we look at the trends going forward, the growth is unlikely to be 2% or higher per year, just 1.4%. And that is because significantly more foreign debts than foreign assets, high, extremely high non-financial debt levels. And yes, it is in own currency, which mitigates its debt risks, but that you can mitigate only with inflation. So the outlook is not positive. China looks mixed, at least not negative, but still it has 4.3% growth per year, and Eurozone looks the worst with next 10 years practically no economic growth, at a recession, and these are again positive linear expectations. And Europe will be like Italy, having no economic growth going forward. So when countries have good times, but those are based on debt, at some point that debt doesn't work anymore. We already see that in Italy, in Spain, in France, and next is also other countries. I hope it doesn't happen as soon, but these are the fundamental economics that matter when it comes to your investing and investing outlook. And just a side note, if you're looking for value investing, no matter the economics, where we own businesses and try to constantly build wealth through owning more, through dividends, special situations, check my research platform where there are plenty of such value investment unrelated to market ideas. And the thing is that with all the debt that has been issued, at some point it doesn't work anymore. Now, it's not that it will be terrible, but it won't be great. And as I'm from Croatia, I will give you just some explanation. In 2005, there were 12% of Italian tourists coming to Croatia. Okay, you see, Croatia is very close to Italy, and Ferragosto Italians would enjoy the Croatian coast. However, 15 years forward, Italians went from 12% of foreign tourists in Croatia to 5.6%. That's a huge decline, and you can see that the Italians don't have the money they used to have 15 years ago. Germans are on level, but there has been a drop in spending in Italy. You can see that around Italy, France, and that is the cost people are paying, slowly and steadily declining, and then on top of that all the other issues compiling, politics, bureaucracy, whatever. That is the key here, and when it comes to investing, you want to be invested with tailwinds. And my message here is that slowly and steadily, and we'll discuss that also outlook for the US now, that joy of life, that cherry on the cake is slipping away, and you don't feel it. 15 years pass and you look around and you miss that wealth you had. That is the biggest risk for developed economies going forward, alongside stupid things that politicians might do, but I will not get into that. And if you want to hear something on that topic, which is very important and gives you the detail, from Stanley Druckenmiller. I'll put here a card so you can watch that video. You can also read it online, just Google it, Stan Druckenmiller, USC Marshall, and he discusses exactly what has happened in Italy. And look at this. These are the expectations. Federal spending, percentage of GDP. GDP will grow, but this will grow faster. Medicare, Medicaid, and all these entitlements, and those will just grow and grow and grow. In 20 years, entitlements will cover 60% of all taxes. Thus, that is long-term negative economic outlooks. And the debt has already been piling there. We are at World War II levels, and this is also a reason why stocks most up thanks to the debt that has been issued, the lower interest rates. And look at here, bottom of debt, when people said, okay, now we have to change something, 1982, bottom of the market, this is adjusted for inflation, 1982, and since then it has been nothing but up. However, when there is deleveraging, you know that it can be nothing but down for a very, very long period of time. And further, you can read that, but what is worse is that the current debt levels that we just showed do not account for what the government has promised it will pay you in terms of Social Security and Medicare. It actually assumes these payments will be zero. And further, Druckenmiller discusses it. Structural deficits are piling up crazily, and therefore I'm saying this is unsustainable. We have seen what this has led to Italy, Spain, etc. There are technological advantages, education, etc. However, at some point, this net interest on the debt that's already issued starts becoming a huge burden, 27% of total outlays. So the situation is not good, and despite that, we have asset bubbles now. People are rushing into now AI, it was Bitcoin, ARK a little bit, FANG again, biotech earlier, and those bubbles usually deflate. But when it comes to investing ahead, I don't think it is that smart to just bet on a Fed ECB put, because we need to take into account fundamentals versus reality. And when you look at that, there are much better options around the world. I was just looking at Asian stocks on my research platform. This is the expectations for economic growth in the Philippines. So 6% going forward, and compare that to the debt burdens in developed markets, interest payments. I would say, first and foremost, avoid discrepancy-based short-term picks. Yes, interest rates might go lower, you make 20%, and then what when it comes to long-term investing? So look at what you own and what is the risk and reward of what you own. Is it based on fundamentals? No matter what happens, I end up okay in 5 to 10 years, or are you betting on something being positive and this debt cycle continuing? For what I'm doing, check my research platform. I'll see you in the next video.